America's retail empire is collapsing in real time. Once unstoppable giants are bleeding cash, closing stores, and drowning in billions of dollars in debt. The shelves are empty, and the customers are gone. Bankruptcy filings have surged 16.8% in a single year, marking the largest retail death wave since the pandemic. From Party City to Red Lobster, these household names are now liquidation headlines. Sky-high rents, record inflation, and a vanishing middle class have ripped the heart out of Main Street. This isn't just a market correction. It's the execution of American retail as we knew it. The downfall has begun. Number 10. H. Gregg. H. Gregg once symbolized the rise of middle-class America, a place where appliances, electronics, and living room dreams were stacked in bright aisles of endless choice. But behind that glow sat a business model that was already obsolete. After its first bankruptcy in 2017, the company attempted a comeback under private ownership, promising a leaner, digital-focused strategy. What followed was a slow-motion implosion that revealed the brutal economics of U.S. retail in 2024. Too many stores, too few buyers, and a consumer base buried under $1.14 trillion in credit card debt. Across dozens of states, liquidation banners replaced the old "better prices, better people" slogan. H. Gregg's revival never stood a chance against rising interest rates that crushed appliance financing and housing sales that plunged more than 20% year over year. The chain's core products, big-ticket refrigerators, washers, and smart TVs, depend on confident consumers with spare credit. But those same Americans are now prioritizing food, fuel, and rent. When real wages stagnate while energy and utility bills jump 30%, discretionary spending dies, and retailers like H. Gregg suffocate first. By late 2024, the company's operational costs had ballooned beyond control. Commercial rents were up 24%, warehouse insurance premiums up 18%, and freight costs remained nearly 40% higher than pre-pandemic levels. Even online sales, once hailed as the path to survival, couldn't offset the crushing fixed overhead. The retailer's final balance sheets reportedly showed multi-million-dollar quarterly losses, with inventories depreciating faster than they could be sold. What H. Gregg's collapse reveals is not simply poor management. It's structural decay. A business that thrived when every suburb was expanding now faced a nation contracting inward. Malls are empty, consumers exhausted, and retailers trapped in leases written for a different economy. In the end, H. Gregg didn't just lose a market. It lost the economic environment that once made it possible to exist. Its disappearance marks another hollowed-out space in America's retail landscape, proof that the middle class no longer powers Main Street, only mourns it. Number 9. Red Lobster. Red Lobster's downfall is not just a business failure. It's a mirror of collapsing American spending power. The seafood chain that once symbolized weekend luxury for working families has become a casualty of the cost crisis. It could no longer hide behind promotions. A decade of mismanagement, compounded by inflation, turned its endless shrimp marketing gimmick into a corporate time bomb. Each quarter, the company hemorrhaged over $10 million as food and labor costs soared beyond what its menu could sustain. The restaurant's financial structure was built for an economy that no longer exists. With seafood prices climbing more than 28%, rent costs up 22%, and electricity bills at record highs, even full dining rooms couldn't generate enough margin to break even. But the real wound came from changing consumer behavior. Household savings fell to their lowest point in more than a decade, and discretionary dining became the first luxury to vanish. By late 2024, Red Lobster was carrying over $1 billion in debt, with interest payments alone consuming millions each month. Its bankruptcy symbolizes a broader trend. Americans are not eating out less by choice, but by necessity. Restaurants across the U.S. now face a financial reality where profit margins, once near 10%, have fallen to just 2% to 3%. Labor shortages forced hourly wages to rise by 18%, while insurance and compliance costs skyrocketed. Every location became a liability rather than an asset. Red Lobster's liquidation wasn't just the end of a brand. It was the signal that the casual dining sector itself is imploding under the same weight. The chain's closure leaves thousands unemployed and hundreds of leased properties sitting dark in commercial corridors, already half empty. Behind the glossy images of shrimp platters and family celebrations was a balance sheet rotting from within, an unsustainable promise in an unsustainable economy. The final check has been served, and it's clear, when America's middle class can no longer afford its own comfort food, the collapse is not culinary, it's economic. Red Lobster's demise is more than a company failure. It's the obituary of affordable dining in a shrinking nation. Number 8. Rue 21. Rue 21's bankruptcy marks the death of the traditional American mall and the generation of retail it represented. Once a vibrant youth clothing brand with over 600 stores nationwide, Rue 21 collapsed under the weight of a retail system designed for an audience that no longer walks through mall doors. As online fast fashion empires like Shein and Temu exploded, Rue 21's business model, dependent on foot traffic, seasonal cycles, and mid-price appeal, was rendered obsolete. Over the last 3 years, same-store sales dropped more than 35%, while digital engagement stagnated. The average US teenager now spends 80% of fashion dollars online, leaving brands like Rue 21 with massive rent overheads and unsold inventory. By 2024, the company's cash flow had turned negative for 9 consecutive quarters. Leases signed in the 2000s for bustling malls became financial anchors as shopping centers hollowed out across Middle America. Every store carried fixed costs exceeding $40,000 per month in rent, utilities, and staffing. Costs that could no longer be justified by shrinking revenues. Labor inflation added to the collapse. Retail hourly wages climbed 15%, health coverage costs rose 20%, and turnover increased as workers chased higher pay elsewhere. What followed was a vicious cycle of low morale, higher training costs, and declining customer experience. Rue 21's marketing pivot to digital came too late, and with inventory debt mounting past $120 million, the company's third bankruptcy became inevitable. The fall of Rue 21 isn't about poor branding. It's about structural decay in the US retail ecosystem. Physical fashion. Retail has lost its cultural core. Malls are deserted, local advertising is irrelevant, and trend cycles move faster than store logistics. A brand once built on teen identity couldn't compete with algorithmic fashion driven by social media. Rue 21's closure underscores an era-ending reality. The American mall dream has died. The clothes didn't go out of style the way Americans buy them did. Number 7. Jo-Ann. Jo-Ann's decline reflects something deeper than a failing craft store. It symbolizes the collapse of American creativity under economic pressure. For more than 8 decades, the brand served as a foundation for home projects, small businesses, and local artisans. But by 2024, the threads holding it together finally tore apart. Same-store sales plummeted by over 20%, while operating costs exploded. Rent, wages, and energy bills devoured profit margins that once relied on steady foot traffic and discretionary income. When inflation turned hobbies into luxuries, Jo-Ann's loyal customer base simply vanished. At its peak, Jo-Ann operated more than 850 stores nationwide,